Welcome back to Miller Momentum. Man, have I got two juicy audience submitted portfolios for you today. I also want to take a moment to post a little reminder about my core strategies as well, each of which will eventually get a dedicated video. But first, a quick disclaimer. I am not a financial advisor, and this is not financial advice. The content in this video is for entertainment and educational purposes only. Past performance is not indicative of future results. Statements made are my opinions. Investing involves risk. Always do your own research. So, to recap, in addition to doing deep dives on various ETFs and funds, I talk about five core portfolio frameworks or designs or architectures, whatever term you want to use for them, on this channel. And these five core designs, they're not dogmatic. I'm not going to get on here and tell you guys something like, this is the best three fund ETF portfolio ever, beats everything. No, 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 no. These are more like recipes. And this is how I personally build these recipes for myself. And these are with the funds that, in my opinion, I think are the best available in the US retail market. So, first up is the Meridian portfolio, and it's all about balance. It is my upgrade, update, or personal take, however you want to phrase it, on the classic 60/40 portfolio design. So instead of having a whole USA market fund for the 60% equities, I divide it between a value factor fund and a momentum factor fund, ideally global, because I like that international investment. Now, for the US retail space, there aren't many very good one fund solutions for the momentum allocation. I am personally convinced that VFMO is the best momentum factor strategy available to US investors. So that's the one I use, sized at 30%. And then for global value, well, we've got an incredible fund for that available to us, and that is AVGV. So that's what I use for the other 30% of the equities. And it's bringing in about, when you crunch the numbers, about 20% of equities is in international at that point. And that's fine. Vanguard's research, Morningstar's research, they show that most of the benefit from international diversification is already obtained at about 20 to 25% of your equity allocation. Ideally, I'd want it to be 30 to 40%, but I'm not going to let perfect be the enemy of the good here and dilute my momentum strategy with a less ideal international one, even iShares, which is really good. But I'm just convinced that Vanguard has the best structure here with VFMO. So that's the one I went with. And for the 40% bond allocation, instead of that, I replace half of it with catastrophe bonds and the other half with managed futures. And I've gone into depth in a lot of videos about why I believe that is a really good idea. And it does result in better risk adjusted returns and overall returns as well. So, second up is the Atlas portfolio, and it's more of an all weather design. And it's using the AVGV fund for its equity allocation. And because it's built to take advantage of downturns in choppy markets, it doesn't go with any momentum allocation, actually, because it's capitalizing on accruing its gains when everybody else is stalled out. So it's kind of a mirror image or inverse strategy there. But it does have GDE, which is 90% equities with 90% gold. It is a leveraged fund from Wisdom Tree. I really like it. I'd like it better if it had global equities, but again, I'm not going to let perfect be the enemy of the good here and get all fancy when one ticker will suffice. I'm sure at some point down the line, Wisdom Tree will offer an international version of GDE, or Return Stacked will do a global version of it. Who knows? Until then, GDE is good enough. And then for the other 50%, it's a split between DBMF, and which is managed futures, and cat bonds again. And I use CBYYX, the Victory Pioneer Cat Bond Fund, for my Atlas portfolio. Whereas for the Meridian portfolio, I use ILS. There's not really any um, higher reason for that other than its diversification across two different cat bond strategies. I think ultimately both of those funds will come out to be about the same. And if you want to hear my more detailed thoughts on that, go check out my video. Does the new ILS cat bond fund suck? Yeah, I had to game the algorithm, so I gave it a great title. So that's the Atlas portfolio. And if you look really close enough, you may actually notice that it is a slightly leveraged form of the classic butterfly portfolio. So bonus points if you figured that out, because GDE is a leveraged fund. It's kind of like 25% equities and 25% gold. So it's actually a 125% portfolio. So you've got 20% in value equity, 20% in an index equity, 20% in gold, 20% in managed futures, and 20% in cat bonds. So it's a nice little twist on the butterfly portfolio structure overall. And that would be the golden butterfly portfolio, if you're familiar with the repertoire of lazy portfolios available. The third core strategy is going to be the Azimuth portfolio, and it um, really leans into trend following. It's all about adaptability. So it's another take on the classic 60/40 structure, but this one is really embracing the KISS principle, and it goes momentum equity and managed futures. Um, Now, this one doesn't have any international equities exposure at all, but since DBMF can go long or short on international equities futures, it has that diversification built in dynamically in a hidden way. So it's not a pure bet on the US market. And VFMO is not that different from VMO, which is Vanguard's global momentum strategy. Unfortunately, not yet available to US investors. But again, not letting the perfect be the enemy of the good. So VFMO is good enough here. The Zenith portfolio is much the same way as the Azimuth portfolio, except the equities is split between VFMO and AVGV. So it takes advantage of the beginning of market recoveries a little bit more with that value allocation, and takes advantage of crashes because either momentum or value is going to crash a little bit more in a huge equity drawdown. So one or the other is going to be buying the other at the bottom. So really neat little structure there. And then finally, for the maniacs out there who want to try an all equity portfolio without any diversifiers whatsoever beyond equities, just use equities classes. The best that I can think of is just to split between two funds, VFMO and AVGV. So you've got the best available momentum allocation, one fund solution, in my opinion, that's out there for US investors, combined with the best one fund solution for value. Now, if you're outside of the United States, this would look a little bit differently. I'd probably build it as a VMO combined with Avantis Global Value, or Avantis All World Small Cap Value Fund, depending on what was available. So there's the fun lineup of the 5 core Miller Momentum strategies. Before we get into the user submitted portfolios, let's take a look at how these core strategies function in action. So, to be able to take you back 54 years, and I do believe in really long back tests whenever possible, I've had to get a little bit creative in the funds used to demonstrate these strategies. So for AVGV SIM extension, I used AVGV and then backfilled that with LVAGX and LVG. And that strategy, for those unfamiliar, is going to be the LSV Global Value Fund. And then before that, I used equivalent funds from Dimensional and arranged them in the same way that Avantis arranges its own factor ETFs to create AVGV, since AVGV is a fund of funds. And this is defensible because Avantis is a direct successor of the dimensional investing firm. The methodologies employed are almost identical. So the back test in this case is valid. And then for before that, I just substituted out the US centered value sleeves for the Vanguard value indices for each of the cap sizes: large cap, mid cap, and small cap. And then for international, I just used VXUS, which we've got data on going back to the 1960s and such. So, well, 1972 is the farthest back that I can take all of these together. So AVGV SIM extension is going to slightly underestimate returns because its international exposure is just plain vanilla, going back after a certain point. It's not value tilted before you get to the 1990s. So GDE SIM, well, it's really easy to simulate S&P 500 combined with gold. This is a ticker that's already built into testful.io for that very reason. For DBMF, the way that I modeled that is we've got the DBMF index and its returns going back to about the year 2000. I took that return sequence and did a Monte Carlo on it and extended it back to 50 years. So that's also going to underestimate things. It's going to preserve the uncorrelated nature of the sleeve, but it's not going to preserve the inverse correlations due to shorting equities or going long on falling rates or rising rates during those pressure points. So, again, that's going to underestimate things a bit, which is not a bad thing because when you're doing a back test, you want it to be worse than it actually would have been, so that your decision is very much informed by a kind of a worst case or realistic outcome instead of something optimistic that'll make you go for the big numbers. You know what I mean? And I did a similar approach for CBYYX. CBYYX is actually very comparable to the Swiss Re Cat bond after you input fees. So I got the index for Swiss Re Cat bonds, applied the fees for CBYYX, that extends it back to the early 2000s. And then for a time period before that, just go over to the Monte Carlo simulation, take the median return path, and use that to extend back 50 years. And again, this is going to be a more conservative estimate of the strategy for Atlas, but um, that's fine. Conservative is good for back tests. For the Meridian portfolio, for the momentum segment, I just use the SPMO index because that's one that's built into testful.io. And over long periods of time, momentum strategies tend to converge anyway, although smaller caps do better than larger caps. So, again, this is going to be kind of a conservative estimate of what a momentum strategy does over a long period of time. We've got the same other simulated tickers with their backfilled history and as well. For the Zenith portfolio, again, using SPMO for the momentum slot there. Um, then for the Azimuth portfolio, same thing. And for the Nadir portfolio, using SPMO SIM and AVGV SIM again, and looking at the full 54-year back test, which should give you a very good sense of what these strategies do over time. You can see the returns are all really good with very good max drawdown, except for the Nadir portfolio, which is going to be all equity all the time. So it's going to have equity like drawdowns and a more equity like risk profile. It does outperform the other strategies over a long period of time, but not by as much as you think that it does. And during periods when equities really struggle, the Atlas portfolio is actually going to be the one usually at the top. And it was at the top for um, well over the first decade after 1972 in this backtest until the Nadir portfolio ultimately overcame it and just tore in front and kept the lead for pretty much ever. Now, I want to add to this the S&P 500 and the total world market so you can get a good sense of how powerful investing in alternatives and factor strategies really can be. So the S&P 500 and the total world market are shown by this lime green and orange line, and they are typically um, at the bottom of all of the strategies here for most of the time. Their compound annual growth rate and money weighted return rate are going to be smaller than the all of the Miller Momentum core strategies. This typically holds even when you're doing, say, monthly contributions. We're just going to put in $800. You can see the money weighted return is going to change a little bit. The Atlas portfolio is one of the most stable. The Meridian portfolio is going to be pretty stable itself. So really two good strategies there, uh, but with slightly bigger drawdowns for the Meridian. Then Zenith, Azimuth, and Nadir, they're all going to be up there. You can see that the S&P 500 and the total world market over a long time, just because of the U.S. dominance, the S&P 500 did ultimately overtake with those monthly contributions. Three of the Miller Momentum strategies, but that's fine because those strategies really aren't meant to overtake the S&P 500 with monthly contributions over this long period of time, and the differences are not really going to be practically important to somebody who ends up with, $29 million after 54 years. You're not going to feel that much of a difference between 29 million, 40 million, and 21 million unless uh, money spending problems are a real issue. And of course, the Nader portfolio comes in at the top at 90 million. Not a surprise when you combine 50-50 momentum and value. You better be prepared for a rough ride, but eh, if you are, it typically has the biggest returns over time. So that's just to give you a sense. For the rolling metrics, you can see that just comparing the Atlas portfolio here to the S&P 500 and total world market, it's a very steady compounder, and that's why I have it in my retirement portfolio. The Meridian portfolio is kind of the same, but a little bit more tilted toward equities, whereas the Zenith and the Azimuth portfolio are going to be even more tilted toward equities, and some people are into that because they like to track the market. Tracking error is a big psychological thing. I really don't care as much about it, but other people do. And then the Nader portfolio is going to be all equities all the time, and it's going to be typically above the S&P 500, except for periods of extreme U.S. outperformance. And then the total world market is going to be uh, up and down. I mean, ultimately, I expect the S&P 500 and the total world market to converge because the S&P 500 is a geographic bet within the total world market. and mean reversion always happens sooner or later. So those are the core 5 Miller momentum strategies compared to the S&P 500 and the total world market. And it's time to get into our user submitted portfolios that took these recipes and remixed them in exciting ways. First up, the Horizon portfolio. This cool take on the Meridian portfolio comes from my wife, and it's quite brilliant. So instead of just a 30-30 split between momentum and value, she wanted to tilt more toward value, which is certainly a very defensible choice, especially in the current macroeconomic environment we find ourselves. And back testing, um, she gets about the same result as the median or the Meridian portfolio, rather. A little bit better volatility, though, and a reduced longest drawdown. And again, these two strategies are neck and neck, with the Horizon portfolio crossing over the Meridian portfolio from time to time. And I think it's a very elegant and brilliant implementation, just a very simple tweak of one of the core strategies. And this is the strategy she uses in her Roth IRA. And thank you, dear, for letting me share that. I know that you're one of my probably two female viewers. And now, let's look at the Ranger portfolio. Now, the idea of the Ranger portfolio is to take the basic Atlas portfolio idea, but implement it in an 80-20 portfolio style. So, more equities, less diversifiers, but without sacrificing the all weather components completely. And so we've got the Ranger portfolio back test lined up here. For SPGM, that is just State Street's implementation of the MSCI World Index, which over long periods of time converges to VT. So VT is a good substitute to back test this. Then we've got GDE, we've got the DBMF sleeve that has been extended as explained before. NTSX SIM, again, 90% equities, S&P 500 with 60% intermediate treasuries is really easy to model. And then we've got AVGV down there at 20%. So, looking at the lineup of the core Miller momentum strategies with the Ranger portfolio, the Ranger portfolio's returns come in somewhere between the Meridian and Zenith portfolio and the Azimuth portfolio. But its max drawdown is more comparable to the Nadir portfolio, and its average drawdown is also more comparable to the Azimuth, or right in between there, between the Azimuth and the Nadir. More comparable to the Azimuth, though. Its longest drawdown is greatly improved, though. It's more comparable to the 4 Miller momentum strategies that use diversifiers, and its volatility is a lot less than the Nadir portfolio, which is the all equities one. Its Sharp ratio is 0.55, which is pretty good for an all equities strategy. To just give you a comparison, if we call up the S&P 500 as a benchmark here and run the back test again so you can see how the Ranger portfolio compares to it. See, it's going to have a much higher Sharp ratio. So the Ranger portfolio is getting better risk adjusted returns, and it's also getting above the S&P 500 as the other core strategies for Miller Momentum do. So pretty cool portfolio. I like it. If I were implementing the Ranger portfolio, which you can see in this orange line right here, I might try doing something a little bit different. I'm going to clear out the other strategies so that we can narrow down the comparison here. So we're going to have Jeffrey's Ranger portfolio here. just to compare the two. So for NTSX, um, it is adding a little bit more US equities, but it's not adding that much in terms of bonds. Now, in a previous video on return stacking, I did say that I'm not totally convinced that stacking bonds is going to do exactly what people think it will, especially intermediate bonds. But in this case, what I would do is I think that you can get the same bang for your buck by going with RSSB instead of that global equities allocation. So you can have 35 there, and that frees up 10% to use in other places. So you can put that 10% in, say, DBMF, because this is a big equities portfolio. And so this is going to be closer to an 80-20 mix in any case. And running that, we can see how it changes things. So by actually taking NTSX out and using that extra 10% to DBMF, we've simplified the portfolio to 4 tickers. And we have also greatly improved max drawdown. We've greatly improved the average drawdown, the longest drawdown, and the volatility and the Sharpe ratio here. And we've also improved the compound annual growth and money weighted return. And that's because when it comes to capital efficient funds, leveraged funds, more is often less, and less is often more. So instead of having NTSX, we just folded our extra bond exposure into our global allocation here, making more room for managed futures to help us in equity downturns. And those that really pays off because this strategy saves a little bit more of its wealth. And you can see this looking back at the historical trend line here. So in the .com bomb, the original Ranger portfolio that was submitted loses more of its wealth than the modified Ranger does, because the modified Ranger is allocating more to managed futures. So it lessens that drawdown, right? So that's why the Ranger portfolio ends up being behind, because it loses that wealth. It takes it longer to gain it back. Then there's another crash, and now Jeffrey's Ranger is ahead, and it's taken until right now in 2026 for the two to begin to converge again. So when building a portfolio, I think it's important to go for maximum simplicity. See if there's too many tickers, and make sure that every allocation is doing the most that it possibly can, and not to fall into the common trap of thinking that more equities means more return, because that is not actually true. A huge thank you to AMG for submitting the Ranger portfolio for consideration. And even though it was named Jeffrey's Ranger in the backtest, that was just to distinguish it. It is totally your portfolio. The Ranger portfolio is something I really like. I think it's a really cool adaptation. Um, I would personally do the tweak that I did, just because, if I was running it, I wouldn't want to have such a large drawdown and greater returns for less risk. I mean, that's kind of the name of the game, right? Now, as for why it's called the Ranger portfolio, well, AMG and I got a little bit nerdy and talking about Dungeons and Dragons, and I mentioned that I tend to think about portfolio construction like characters. So the Meridian portfolio is kind of like a balanced battle paladin. The Atlas portfolio is a barbarian that rages when the market goes sideways or dips. The Azimuth portfolio is kind of like an arcane trickster, a rogue type with some magic, because the DBMF is a sneak attack during market downturns, and momentum as a strategy is quite agile. And the Zenith portfolio is a fire dancer because it profits both from trends and trend reversals. And then your Nadir portfolio is the mage because it's the glass cannon of the bunch. Thank you so much for watching Miller Momentum. I hope you enjoyed today's video. Hey, let me know what takes you've got on the Miller Momentum core portfolio strategies down in the comments. What portfolios have you built? I'm eager to see. And don't forget to like and subscribe, y'all.